So other than potentially selling some Bitcoin in order to pay the expenses, Bitcoin never really leave. It's kind of a Hotel California of Bitcoin, and so that was a really big contributor to Bitcoin's price going up. For most people should not be professional traders, whether it's crypto or whether it's traditional assets like stocks and bonds. And so generally the best approach is dollar cost averaging over time. One of the largest reasons and one of the most underreported reasons was the fact that Grayscale's premium over NAV for the Grayscale Bitcoin Trust went away, turned into a discount. And so if you look at that fund in the second half of 2020, that was the largest buyer of Bitcoin. They were a massive buyer, bigger than MicroStrategy, bigger than any other buyer. The sheer amount of coins they sucked up, and part of that was natural demand. People want Bitcoin exposure, so they buy it in their brokerage account through GBTC. It's an imperfect vehicle, but they relied on that. But two, a lot of that was a neutral arbitrage trade. So someone could, accredited investors could buy into the fund at NAV, which basically took liquid Bitcoin, converted them into that fund, made them illiquid Bitcoin. So you had to, basically off of exchanges into their cold storage, and then they would go and short Bitcoin elsewhere. And then after 6 months, when that lockup period ended, they could sell their GBT shares for the market price, which was generally trading at a premium over their NAV, and they bought in a NAV. And so regardless of what Bitcoin's price did, as long as there were no tail risks of like counterparty issues or something, they would end their Bitcoin short, they would sell their GBTC, and they would extract that premium. And it was essentially a risk-free trade. So other than potentially selling some Bitcoin in order to pay the expenses, Bitcoin never really leave. It's kind of a Hotel California of Bitcoin. And so that was a really big contributor to Bitcoin's price going up.
Well, so overall, it's pretty weak price action, obviously, at the current time. And so there's, the kind of the two main camps. One is that, it looks a lot like the 2017 bull run we pointed out when we got down to levels like this. That was usually more of a bottom. The deeper risk is that it's more like the 2013 bull run, where you had a much deeper and longer correction during that year. And so, from my standpoint, looking at various indicators, there's not very clear direction on price action over the next 3 months, but there are some clear causes for how we got here. And so, for example, if you look at this 3-month consolidation that Bitcoin was in, a lot of that really started to occur back when Grayscale's premium disappeared, which resulted in that very large investment vehicle no longer being one of the big marginal buyers for the asset. And so if you look back, for example, over the 4 months of the fourth quarter of 2020 and then the first month of this year, Grayscale accumulated something like 200,000 coins. But after their premium dried up, that arbitrage where people would buy into that fund and kind of get that premium difference on a risk-free trade dried up. And so that basically was a big collection from liquid Bitcoins and converting them to illiquid Bitcoins. And that trade is now done.
So we had some increased competition at Grayscale. So we had Canada's Bitcoin ETF. We just have generally more ways to access it. So there's a Skybridge fund, right? So there's institutional, basically custodians. More people are able to just use things like Coinbase or use other major exchanges, right? So we've seen their numbers go up. And so there's basically fewer people that really need to rely on say GBTC trading at a premium over NAV and 2% fee or whatever it is last I checked. And so basically that with that discount gone, that neutral arbitrage trade can't happen. And so that the biggest buyer just switched off completely. It hasn't been buying Bitcoin. And then when you get things like Elon Musk backtracking on his views on Bitcoin being ESG, or some of these other things like the Chinese hash rate migration, any of these other things can then come and impact it. But I think part of the underlying thing was essentially that just one of the big sources of demand dried up, and therefore the market had to rebalance itself.
We've already retraced a lot of the price gains since the announcement of Tesla's purchase of Bitcoin, and so I think that the community overall sometimes goes through periods where they're overly reliant on one source. So, for example, I mentioned how big of a force that Grayscale was for a while, and then we kind of transitioned to the Elon source. But for Bitcoin's health overall, it can't really be tied to the decision of one person or one group of people. and it's really about the network's going to succeed or not succeed based on its inherent technical nature and based on its network effect. And so I think it's unfortunate that this Elon kind of reversal came out, because it actually overshadowed some more promising news around some of the partnerships that, for example, NYDIG is doing with banks and with progress in Taproot and things like that. So while kind of the price action is attracting a lot of the headlines, under the surface, the fundamentals and the network effects still look robust. I think ETFs would be a positive catalyst. Before it would have potentially been a negative catalyst, because it could have taken away this GBTC premium trade. But now that that's already over, a Bitcoin ETF coming about would open up newer sources of demand. So a lot of money managers and stuff would feel more comfortable and basically able to access that market more easily for their clients if there's an ETF in the United States. And so I think that's one of the catalysts that can help out.
So basically, the idea of something like gold or Bitcoin or these other kind of hard assets is that in an environment of negative real yield, those harder assets generally hold up pretty well compared to holding large amounts of fiat currency. Now, fiat currency can still be useful tactically. You have to pay your short-term obligations, but in general, you wouldn't want to hold it for many years for a large percentage of your assets.
Yes, I remain long Bitcoin, and so for my type of investing style, Bitcoin is one of the segments within a larger diversified portfolio, and so we branch out into multiple different asset classes, especially equities, and Bitcoin represents kind of a big kicker there to benefit from this longer term secular adoption of digital assets.
Bitcoin is one where the majority of the world can access it, right? So not everyone can access stocks, especially in emerging markets, right? But anyone with a smartphone, which is something like 4 billion people now, can access Bitcoin. For most people should not be professional traders, whether it's crypto or whether it's traditional assets like stocks and bonds. And so generally the best approach is dollar cost averaging over time. Now the difference between something like an S&P 500 and Bitcoin is that Bitcoin's a single asset. You're betting on the adoption of this specific network. And so, for example, I'm generally not one of the people that argues that people should put 100% of their net worth in Bitcoin or other cryptos. But as a slice, maybe owning their own home, maybe having an equity portfolio, maybe having some commodity investments, whatever they are knowledgeable in or bullish on. I think that dollar cost averaging into something like Bitcoin, in addition to those other slices, can be an important part of, say, a long-term strategy, as long as they're continuing, to be bullish on that network. If I was in Argentina, if I was in Brazil, if I was in any number of these countries, as volatile as Bitcoin is, it's more attractive than holding large amounts of the local currency. And so I do think that these forces will be continually, beneficial for the protocol over the next 5-10 years.
And because federal debts are so high, and because we've been in this kind of long period of disinflation, at least in some categories, they're very kind of adamant about holding rates pretty low. But in the long run, that kind of environment should be good for most real assets or most scarce assets of some sort, because when your cash holdings are failing to keep up with inflation, there's a strong incentive to go out and buy things like commodities or gold, or we'll see how Bitcoin responds here, but overall a scarce asset like Bitcoin should do pretty well in that environment.
They could sell their GBT shares for the market price, which was generally trading at a premium over their NAV, and they bought in at NAV.
Liquid Bitcoins and converting them to illiquid Bitcoins, and that trade is now done. We've already retraced a lot of the price gains since the announcement of Tesla's purchase of Bitcoin. Bitcoin is one of the segments within a larger diversified portfolio.